But what they're talking about, what it sounds like is going to happen is they're going to cut the capital gains tax discount from 50% to 25%. So they'll halve it. So what that means is instead of before the tax is calculated on a capital gain, you take 50% off it, you can now only take 25% off it. And so instead of being taxed on 50% of the capital gain, you end up being taxed on 75% of the capital gain, which effectively means a 50% increase in the amount of capital gains tax you pay, if I'm doing the math right. I think so. I hope so. That's pretty simple math.
Now, the number you mentioned there, that was the same policy that Bill Shorten took to the election against Scott Morrison back in 2019. And then Bill Shorten lost that. Look, I suspect, I have no inside information. No one in Labor gives me the goss, right? So but this is just my guess. I suspect they're going to say something like switching CGT to 40%. Right. So they're going to say that like the last shift was too big. This is a small shift. They're going to make the case, which is half persuasive, that 40% will still compensate people for the inflation effects of their capital assets. And it'll just sort of wind back that a little bit. So that's where I think they'll go. But can I put this in a bit broader context for the listening to you? And I'll do it with answering a question from Aussie. G'day, Aussie. Ask the question, which tax cuts give us better economic benefit, personal rates or company tax rate? Now, firstly, I'll answer the question and then I'll just segue onto what I want to say. Company tax rate is mostly just a prepayment of personal rates in Australia because we have dividend imputation. So income tax rates are more important to cut than company tax rate. But it's kind of, with no disrespect, Aussie, it's kind of the wrong question to ask, right? So the question to ask is, and this probably is the question you might have thought you were asking, but the tax on income earned by working or the tax on income earned on capital. So labor income or capital income. So which tax cut, the tax cut on labor income or the tax cut on capital income, which of those gives more economic benefit? And the answer is the answer is pretty unambiguous, but it's not the answer most people want to hear. And that is, taxes on capital income have a far worse economic impact, right? Capital is far more mobile, right? And most people are going to have a job. They're going to need some sort of income from working to get by, but you don't necessarily have to make that next investment.
Yeah.
Right? Instead of making that next investment, you could just buy a yacht, right? So the capital is much more movable, much more elastic, right? So when you change the way you treat capital income, you get a much bigger response. Then with the way you change labor income, you get a much smaller response. Also, you may have heard us saying this before. I repeat this so often, you must be bored of it, but I'm going to keep saying it. Our economy is in the toilet because productivity is low. That's why your wages aren't going up. That's why prices are going up. That's why you're not feeling any richer. That's why things are getting more difficult. That's why we can't balance the budget, right? This productivity is a big problem just sitting below the surface of most things about our economy, right? The only way of fixing productivity is more investment in innovation. Investment in innovation. That comes from capital, right? You have to invest in capital. And it's the capital income that comes after you invest, right? So that's the side of the economy that actually drives productivity. So it's more responsive and it's the thing that drives long-term wage growth, right? So this is why it kind of does matter how you're taxing capital income. And this is where we get into capital gains tax. So just to nerd out on you just a little bit more, right? There are multiple ways you can get capital income, right? So how do you get capital income? Well, you save some money, you invest it. So you can just put it in the bank. That counts as investing it. You could buy some shares. That counts as investing it. You could buy a property. You could buy some gold. You could buy some Bitcoin, right? So you save, you invest it. That invested money then goes into building up capital stock. That capital stock earns you an income. And you could receive that income either because the capital asset appreciated. I don't need to learn how to turn that off at some stage. The capital asset appreciated, like you bought gold, the price of gold went up and you sold gold. That's capital appreciating. Or it could be you bought shares and you got paid a dividend. Or it could be you left your money in the bank and you got paid interest. These are all types of return on capital, like capital income. So you get capital income through interest, through dividends, through capital gains. And then all of those three, just to show you how stupid our tax system is in Australia, all three of those are taxed differently in Australia. Right? So you get slightly different treatment depending on whether you're getting interest, dividends, or capital gains, but they're all a form of capital income. And capital gains, you buy shares at $1, you sell shares at $2, you made $1 profit. That's a capital gain, right? You got a $1 return on your investment. Currently, you get a 50% discount on that. So say you made $1, if your tax rate is 50%, you normally pay 50 cents. Well, now you only pay 25 cents, right? So you get a discount. And the common complaint is, well, why are they getting a discount? That's not fair. Fair enough at first blush. The immediate response to that is, yes, but when you hold an asset, you also have to deal with inflation. So imagine you bought an asset right? And I know doing these numbers on the fly gets a bit annoying, but stick with me. You bought an asset for $100. If there's 5% inflation every year, after 1 year, if it was worth $105, you haven't actually made anything, right? That's just staying still, right? If there's 5% inflation and you sell it after a year for $105, all you can do is buy the exact same stuff you could have bought last year. You haven't gotten any richer in terms of what you could buy, right? So yes, your asset went up 5%, but all of the prices in the country went up 5%. So you're no better off. And so the argument is that you need some sort of discount to compensate people for the inflation when you're holding assets. So that's the argument for the capital gains tax discount. And then Labor would come back and say, yes, but the discount is too high. That's why we need to decrease the discount. So that's setting the stage for that debate. And I'd say the Liberals are going to say, stick with the 50% discount. Labor is going to say, let's move to a 40 or a 30 or a 25% discount. Can I just put two other options on the table, then I'll shut up, Gene, and you can rip on all of this. The old system, and not just the old system, but also the system that Jared Rennick supports, is going back to the idea of capital-based indexation. So you notice the problem with capital gains tax is you could be taxing just inflation, which is quite unfair. There is a system for that, and that is you say you could buy that asset at $100. Inflation means it would go to 105. So then what you do is you just say, all right, so that 5%, we don't tax that 5%. Right? That was the old system we had, the asset price indexation. So if you have 5% inflation, then we don't count that. We don't tax that 5% return on your increase in your capital assets. So if you made 7%, well, you don't have to pay anything on the 5%, but you pay capital gains tax on the 2%, right? On the real, we call it real. Adjusted for inflation in economic parlance is real. The real return, you pay your capital gains tax on the real return. That's the system we used to have. That's the system that Jared Rennick suggests going back to. And I'll tell you what, I'm a little bit sympathetic to that. I think you'd actually find more technically efficient outcomes if you wanted to nerd out on the way that tax would work by doing it that way. But I have a fourth suggestion. You got the Liberals, 50% discount. Labor, 30 or 40% discount. They cut the discount. Jared Rennick, go back to the old system of indexing it so you don't pay tax on that inflation. I would say index the capital price to inflation plus 3%. And why that? Yeah. Because I want to adjust it for not only the inflation, but also the time value of money. Now, I've kind of just asserted that it's 3%, maybe it's 2%. I'm happy to have a committee work out the correct time value of money, right? But indexing it, the capital price for inflation, and the time value of money, compensating you for the fact that you have to go a year without access to your money. And we do that all the time. There's a word for it in the English language. It's called interest rates, right? Sort of risk-free underlying real interest rate is the time value of money. And because you have to compensate people if you're asking them to go without some of their assets or go without their spending for a year. So I would argue that that is the most efficient capital tax system. So there's four options on the table, I would say, but I've probably nerded out enough for that. Or maybe I'll write this up and you'll be able to go and see it on Substack soon. But the four options for capital gains tax.
Yeah, and another argument for concessional treatment of capital gains is a comment, I think it's a good one, from Aussie. If you want to show that one, John.
Which one?
The one that's just come in. So even if we go back to indexation, our top tax rate's 47%, which is still very high. Half the real gain is taken and kicks in at 190K. So you might want to have some concessional treatment because if given, if the capital gains realised and then that gets added to your income in a particular year, and then a lot of it's going to be taxed at that top tax rate. So
so the difference is the difference between my system and Jared Rennick's system to some degree, and the status quo will be on how high your returns are. So my approach would be would have lower tax on people who have normal returns, and we end up with higher taxes on people who have super returns, like above normal returns, economic profits in the parlance, the exact thing you're supposed to be taxing in economic theory. So yes, it would increase the tax on people who made windfall gains. If you bought something and it doubled in price in a year, then 50% is going to be a much bigger discount, because in a year, you're only getting, under my system, inflation plus 3% discount, effectively. But if you had just normal returns, if you were getting, say, 6% returns, you don't pay any tax under my system. So that's less than 50% discount. You're paying zero. So my system is more concessionary for people who make normal capital returns and less concessionary for people who make super profits. And I admit that, but I think if you just did the economics of it, I think you'll find that it is more Pareto optimal. What I'm suggesting, it is just more taxing like things in a like way. It makes it more equivalent with the way we tax dividends and interest. And look, these are just getting capital returns, right? We should be ideally taxing all ways of getting capital returns the same way, and my way would achieve that. As a separate point, I would say the top tax rate shouldn't be 47%.
Yeah.
But my system would still be concessionary, because it would be each year you're getting a concession of inflation plus 3%. And if you're just making normal returns, that's going to end up being a bigger concession. But yes, for people who make 100% returns a year, my system would be less concessionary. That's true. But you're not going to have everything. Look, the way I would create a concession for capital investment, to incentivize investment, because investment is what you need to grow the economy, I would do that at the beginning of the process, right? You save, then you invest, you build capital, you get capital return. We're talking about how you tax the capital return. I would make it much more advantageous to save. So then we're going off on a bigger segue here, and I love this topic. I think it is the big missing part of the Australian tax. I think you should be able to put money into a savings trust. The government should give everyone some sort of an official savings trust. And if you put money into that each year, up to, say, a nominal amount, say $20,000 a year. So I'd like it to be open-ended, but to make it politically realistic, let's say up to $20,000 a year, that money is fully tax deductible. You don't have to pay tax on the money you earned that you save. So that's a big tax deduction on the income you earn today if you save it. If you put money into that trust, it goes in fully tax-free. It earns money fully tax-free. And when you take it out, then you pay tax. So that would be where I think you would want to be incentivizing more capital investment. That would be the concession in my world. And then I would adjust the CGT to base plus inflation plus 3%. But anyway, it's a good point by Aussie. The top marginal tax rate is just too high, right? So that's another thing I would do is, look, it's not realistic in our political system to cut the top tax rate. The top tax rate basically only exists so that politicians can convince us that they hate rich people, because then you'll vote for them if you prove that you hate rich people, which is a really deeply sort of fucked up set of political incentives, excuse the language. It does nothing to raise revenue. It hurts the economy. All it does is prove how much our politicians hate rich people, and that makes people vote for them. So that's very sad. That's reality. I think this is just, and then come back on all of this. I'm sorry for talking too much.
Yeah.
Right? It is politically possible. Increase the threshold. You say it kicks in at 190. That's the crime. That should kick in at 500,000 or even $1 million. 47% should be the millionaire's tax, right? It shouldn't apply to people earning $200,000 or $300,000 or $400,000 a year. So I would say that is an achievable reform, right? Push that bracket way up to at least 500,000. That would have a big efficiency gain, right? That would actually really help the economy. You could keep that 47%, so you could still prove to the voters how much you hate rich people. But I think that is a win-win political idea. If anyone from the LNP or One Nation's listening, there you go. That's what you should start to do. Sorry, Gene, you were going to say.
Well, John, first, I think that's a really good idea you had about how to for capital gains tax. So I'll have to think about that a bit more, and be good to, you can put that in a nice policy paper. It'd be good to crunch the numbers on it too. But that makes sense, because economic theory tells us that we want to exempt, we don't want to tax the normal return saving, like the normal sort of normal return. So I think that's good.